Hi, Luke Fannin here from AIT, and in this question we're doing the financial statements for a sole trader, this person here, Jason O'Neill, at the year end 31st of December 2020, and I mean an income statement or a statement of profit and loss and a statement of financial position. So in these type of questions, you're given a trial balance, so it's important to know the year end, and a trial balance has items on the left and the right are the debit and credit. So the items in the trial balance get moved into the format for the income statement and get moved into the statement of financial position. So we just need to know which accounts are assets, which are expenses, and on the left-hand side, or the debit side, the asset and expenses, you'll see the amounts here. On the right-hand side, or the credit side, the amounts here are income, such as sales account. The next one is purchase returns, which reduces purchases. Commission received is income. Provision for bad debts reduces receivables. So sometimes there's a few small items or items which are on the other side, but they're kind of looked on in comparison to the accounts they relate to. So receivables is an asset. So we should see it on the left-hand side. And here's receivables, 10,000. And provision for bad debts, which is up here, reduces receivables. So that's why that's on the other side. If something is the opposite, it must reduce. So, or be on the other side. And then these are the adjustments here. Now, ideally, you start the question, you run through the adjustments, and that's what I'll do. But I just want to make sure people know what goes into the income statement and statement of financial position. So in our income statement, we're looking for a sales account or revenue account. The next few items in the format for the income statement or statement of profit and loss is cost of sales, and cost of sales is made up of purchases, and purchases gets adjusted for these items here. Sales less cost of sales gives us gross profit. Then we add other income, and the other income will all be on the credit side of the trial balance, and we look for interest earned or received, things like rental income or government grants or support, such as the employee wage subsidy scheme, which was given to companies during the COVID crisis. And then these are examples of expenses, and we should see these on the debit side of the trial balance. Now, every trial balance will have different expenses, but these are examples of common ones that we see. And then you end up, after doing all that, with your net profit, or loss, which is your gross profit plus income minus expenses. The statement of financial position is next. And really, the format of this is we put our assets on the top half and our equity and liability accounts on the bottom half. And the total of the assets should equal the total of the equity and liabilities. So our assets are the resources, intangible and tangible items that the company owns at the year end and has value and are expected to bring future benefits to the company. So examples are non-current and current. So long-term assets here. These are examples of non-current. And current cash bank receivables. Receivables always gets reduced for any provision for bad debts. Closing inventory is always the one underneath the trial balance, and prepayments at year end. And then other types of assets are intangible and financial, which you may not see at this stage of your studies in the trial balances. And then the next section is the total of the assets, tells you the resources the company owns and at year end. And the next section, which is equity and liabilities, tells you where the company got the money to purchase or to buy those assets. So equity is the section of the company that belongs to the owner, and it's made up of the capital, which is money invested, less any drawings, which is money taken out by the owner, resources taken out by the owner, plus retained profits or less retained losses. And then we have liabilities, and they get shown as either non-current or current. So here I've highlighted the purchases, adjustments, purchases. Here's opening inventory, minus purchase returns. Underneath here is closing inventory. So they're the items that go into the sales and the cost of sales. And don't forget, our starting point is always sales, less any sales returns. So here's sales returns. So if I'm doing it in Excel here, here's our income statement. Cost of sales always has purchases, usually has purchase returns, and may or may not have carriage in. It's a purchase transport costs of purchases, but usually there is opening inventory and closing inventory. So you just need to learn off the what goes under cost of sales, and then you just put the items from the trial balance in there. And you don't have to have them in exactly that order. You could start with opening inventory and then purchases minus purchase returns. It doesn't matter as long as you have the overall amount right. So picking the amounts from the trial balance, you just put them in like that. Put the amounts in and then work out. I'm using two columns here, and our gross profit is 165,200. And all those figures came from the trial balance. And the closing inventory was 95,000 there. Commission received is 400, and then there are no other income accounts. So then you go less expense. So in our income statement or statement of profit and loss, depending on the name that you're asked to do, you list the expenses down. And so what we have to do is identify the expense accounts in the trial balance and list them down. There'll be more than, I haven't much space here, but you'll have to leave space and put them in. So here's the trial balance. We've done all the cost of sales items and the sales. And so I've just highlighted the expenses in yellow. And as you can see, rent, admin expense, telephone, they're all on the debit side of the trial balance, or the left-hand side, the left column here. Bad debts, another expense. So I will just list these items down, put in the amounts, and that is the expenses. There will be additional expenses for depreciation and any movement in provisions from the adjustments below the trial balance. So as I said, the expenses are on the left-hand column, and there are 5 of them: wages, rent, telephone, rent, admin, telephone, and bad debts. And the other items are either assets on the left-hand side, current assets, so non-current assets or assets, or they're liabilities such as payables. Payables is a liability. These are equity items, and current assets, bank and cash are on the left-hand side. They're assets. If that 4,800 was on the right-hand side, it will be bank overdraft, and you show it in your current liabilities. But when it's on the left-hand side, because bank can either be an asset or a liability, depending on if you've overdrawn your account or not. So once the bank's on the left, it's an asset. If it just said bank on the right, it would be current liability. So to go back here, we have 1, 2, 3, 4, 5 expenses in the trial balance. And here they are. Here I've just listed them down. Wages, rent, admin, telephone, bad debts. They're the 5. And there are 2 others here. So always there'll be adjustments underneath the trial balance. And we need to go through them. But if you have a movement in the provision for bad debts, any movement goes into expenses. A reduction in the provision is like income or a minus expense. An increase in the provision for bad debts just gets shown as a normal expense, and I'll explain that later. And then depreciation is the loss in value or the fall in value of our assets or non-current assets over the period being accounted for. So for the year of 2020, our shop fittings lost 10% using reducing balance, and buildings 5% straight line. So we have to work out the depreciation and put that into expenses. So those 3 things go in as well. Now you'll note that I haven't put in the amounts, and the reason is sometimes because of the adjustments below, some of the amounts in the trial balance need to be changed. And I'll show you what I mean by that. Because our purchases figure, for example, that we have up here needs to be adjusted for because of the notes. So normally when I do this question, I start on the adjustments and go down through them, work out the amounts, and then adjust anything in the trial balance. So really, I think that's the starting point. But I need to do explanations in case people didn't know what they were at or how to start. So closing inventory is the first adjustment, and that goes into cost of sales, and it's also a current asset. Next is telephone accrued by 200. So any amounts owing or due or outstanding or accrued are liabilities, and in our current liabilities, we'll show €200. And we also need to increase expenses. So telephone, we find our telephone. up here. Telephone was 3,000, and now we're just going to say plus €200. And we'll show the total expense for telephone is 3,200. So we paid 3,000, but we owe another 200. So we need to show the total telephone bill for the year. So, for example, for telephone, then our expense is €3,200. And I might put in a note there to say how I got that working. So just a little brackets there to show the % correction where you got the working. Then the next thing is rent. So total rent paid for the year was 16,000, and it says of that 16,000, 2,000 was paid for premises covering from August this year to March next year, March 2021. And you remember the year end is December 2020. So anything paid for 2021 is a prepayment. And the rule for prepayment is we need to reduce the expense for the prepaid amount and show a current asset. So whenever we work out the prepaid rent, we're going to go 16,000 minus the prepaid portion of that, because that is not this year's expense. It's next year's expense. It should be shown next year's accounts. So to work out the prepayment, you look at the period that the rent was paid for. So August 2020 to 31st of March 2021 is an 8-month period. And of that 8 months, 3 months is for after the year end of December 2020. So 3 months, January, February, March, are for 2021. So 3/8 is the prepaid amount. Now this is it just in case this helps you to look at that. So the first 5 months of the period are all in the current year. The last 3 months are in the next year end, the next accounting year, 2021. So to get the prepaid amount, so rent prepaid then is total period is 3/8 for January, February, and March 2021. So 3/8 of the 2,000 is 750. And then all we have to do, we've worked out here, is reduce the expense by 750 and show a current asset. So you come up to rent, and we're going to take away 750. So our rent is going to be 15,250. So that's what we show for rent, the adjusted figure in our expenses. Receivables includes a certain bad debt of 100. So we need to increase our bad debts by 100 and reduce receivables. So from now on, our receivables are 9,900, and we'll show our bad debts expense as 1,200. And there were no adjustment to wage and salaries, no adjustment to admin, so I could just put those amounts in. So just to make sure I know everything else is to do with purchases, is to do with depreciation. So I can come back here and put in the amounts for wages and for admin, 35,500. And that leaves me with the last 3 expense items, which are in the adjustments. So provision for bad debts is 5% of receivables. So we come up to when we find our receivables are 9,900. So our new provision is 5% by 9,900. So 495 is the new provision based on receivables of 9,900. So the 10,000 is reduced by the 100. So 9,900 by 5% is 495. And if we come up here, the old provision was 900. That's gone now. And the new provision is 495. What goes into expenses is the movement in the provision. And so we can see here the provision was 900, and if it's gone down by €405. And it's the reduction. So that's a reduction of €405 on the provision. That's what goes into expenses. So because you can either show that in other income, but I think the easiest thing is to put it in expenses. And if the provision goes down, which it has here, it's gone down by €405, it goes in as a minus expense. It reduces the other expenses. If that was an increase in the provision, whatever the movement or the increase was, would just go in as as a positive. It would increase the other expenses. Next is depreciation, and we need to just look at notes F and G. Include in purchase a figure of 1,000 should have been included in shop fittings. So we need to change our purchases figure. So we had a capital item purchased, which should have been included in shop fittings, but wasn't. So come up to purchases, and we need to take away 1,000 out of purchases and into shop fittings. Add €1,000. So now the cost of our shop fittings is going to be 51,000 and our purchases is going to be 254,000. So I just need to go back and adjust the purchases figure up here. So that's kind of why I always do the adjustments first, because else you're going to end up adjusting or changing your figures. So here's our then, we've done that, and then next we do shop fittings and buildings. So we're asked to calculate depreciation on shop fittings using reducing balance method, 10%, and buildings straight line method, or that's sometimes called the cost method, and it's 5%. So shop fittings written off over 10 years, buildings written off over 20 years. And with reducing balance, I know it never gets written off really, but there are two methods. You need to know both methods, and they're different. So just to explain, the first one we had was reducing balance method that we're asked to do. So the expenses percentage by cost. So it told us 10%. So expense is 10%, and then we just need to put the cost and accumulated depreciation, and then that'll work out for us. So shop fittings are here. The cost is 51,000, and the accumulated depreciation, so the fall in value in previous years in shop fittings was 8,000. So 51 minus 8 is 43. So 51 minus 8, multiply that by 10%, and our expense is 4,300. And that's what goes into our expenses. So there's the 4,300 in expenses, and we just have to remember to increase the cumulative depreciation up here. When we show the non-current assets, the cumulative depreciation is going to increase on shop fittings from 8,000 to 12,300 because it's got that previous 8,000 plus this year's expense. Next is buildings, 5% using straight line, and that's the easiest method. So it tells us building straight line. So the rule for calculate the expense on straight line or cost is just the percentage by the cost. So it's 5% by the cost, and the cost of the buildings is up here on the left is 60,000. Sometimes students take the cumulative depreciation, multiply that by 5%. Just make sure it's always the cost amount. It'll always be the item on the left hand column or the debit column of the trial balance. So 60,000 multiplied by 5%. So we work out the expense that goes into our expenses, and then remember to come up to cumulative depreciation, and that's going to increase by 3,000. And then that is all the adjustments done. And really, if I was doing this starting normal, what I'd start is go down through the adjustments, make the pluses minus in the trial balance, and then run down through the format and put in the amounts. So that's the net profit done. Well, the expense is done, so I just need to calculate the net profit. So here's our net profit, 104,555, which is the gross profit of 166,200 plus commission received minus the total expenses of 62,045. And that gives net profit of that much. If the expenses were greater than the gross profit, we'd have a net loss, and this would be a minus figure down here. Next, we do the statement of financial position. So we need to show our non-current assets and our current assets. And then we need to show our equity and liabilities. So we just pick our non-current assets from the trial balance, the shop fittings and the buildings. So the section is always the same. Your non-current assets, we have three columns: cost, accumulated depreciation, net book value. So our cost are 51 and 60. Here they are, the cost 51 and 60. And the cumulative depreciation we pick here, and it's gone up due to this year's expenses for depreciation. So 12,300 and 9,000. We add the two of them together. So cost minus depreciation. So the shop fittings cost 51,000, but they've fallen in value to 38,700. Buildings have fallen in value. And so our total net book value of our assets are 89,700. Then we look for our current assets, and it's always closing inventory, which is below the trial balance. You'll always have receivables, 9,900, minus provision for bad debts. And you'll remember that the provision for bad debts is now 5% of receivables. So we're going to show receivables, 9,900, minus 5% of that, which is the 495. So they're the current assets. Receivables 9,900 minus 5% of that figure. So we're saying a more realistic or more prudent figure for receivables is a lower amount of 9,405. Bank and cash go in, closing inventory goes in, and remember the rent prepaid and the adjustments. So you're always going to have at least one adjustment where there's a prepayment, and that goes into our current assets. We add our total assets to 199,755. So our equity. So this section tells us where we got the money to have those resources or assets. Equity is always these three things: capital minus drawings plus profits or less losses. Sometimes they're called reserves. So capital and drawings is from the question: capital 95,000, drawings 12,000. And the net profit is the figure that we calculated in our profit and loss account, or our statement, or income statement. So those three things are added together to give total equity of 187,555. Then we put in non-current liabilities and current. So non-current liabilities are those long-term loans, as an example, that would be due for more than a year away. There are none in this question. And we look for current liabilities. So always you'll have payables, and you'll have some kind of amount due or amount owed at year end. So we had here payables 12,000, and once again payables right hand side of the trial balance, the credit side. And telephone is accrued by 200. So accruals. And the total of our equity liabilities adds up to the total of our assets. So that's the statement of financial position finished. So, and I'll just scroll up to the assets so you can see them. It's important to put in the title, the name of the person, and the year end. There'll be marks going for in a question for doing that. And here's the income statement. So thanks for watching. Sorry that was a bit long, but hopefully it's of help to you. Have a nice evening.